Welcome to the Balancing Act podcast with Singer Liwa. Thank you for joining the second installment of our Navigating Tax Season series. In today's episode, Mike Mondelli, director in the firm's tax advisory group, will be leading a conversation with partners Don Rhodes and Stephanie Gunderson. We'll be exploring business tax prep, navigating forms and financials, with insights into the construction, professional services, real estate, restaurant, and professional gambling industries. We appreciate you for tuning in. Let's get started.
Welcome to Singer Liwak's Balancing Act podcast series, Navigating Tax Season, Charting Your Course to Success. I'm your host, Mike Mondelli. I'm a director in Singer Liwak's tax advisory group, where I specialize in IRS practice and procedure and resolving tax controversies. This episode is focused on business tax prep, navigating forms and financials. And we've got two guests with great experience in this area. Two of our partners, Don Rhodes and Stephanie Gunderson. Thank you both for joining us today. Would you mind sharing a little bit about your background and a little about your tax practice?
I'm Stephanie. I'm a partner in the Las Vegas, Nevada office. I've been with the firm for about 5 years, and prior to that, I was in corporate tax as well as public tax accounting. I focus mostly on professional. We do a lot of real estates, restaurants. We have a special market in professional gamblers, which is a really interesting market. And we work with small mom and pop businesses. We have more sophisticated clients. We do a lot of trust and estates, a lot of tax planning. And I think that's one thing that's really important in the tax arena is we can't forget the importance of planning ahead of time because you never know what tax consequences are going to look like. And it's a good idea to get a handle on things.
And I'm Don Rhodes. I'm a partner out of the Woodland Hills office in California. And I have been a CPA for over 40 years, and my specialty is the construction industry, where I spend more time in the accounting side than the tax side, but you have to be in both sides when you deal with that kind of specialty industry. I have a certified construction industry financial professional designation by passing a test, and it's my life is the construction industry.
Yeah, you both are in very nice, warm locations. Here we are recording this in late January. I'm actually located in Minneapolis, Minnesota. If you guys believe it, the temperature here yesterday was negative 25 degrees.
That's so cold.
I might have to come visit you out in Las Vegas and Southern California and get some warm weather.
Yeah, I think we're hitting 50s this week. A little bit of a cold spell for us, to be honest.
So we're gearing up here for the busy tax return filing season over the next few months. Let's talk some about today's topic, business taxes and business tax filing and record keeping. Don, let's start with you. Could you tell us a little bit about some of the unique challenges faced by your construction company clients, either when it comes to tax preparation or bookkeeping? Is there anything different between construction accounting versus what we might all think of as regular accounting?
Great question, Mike. And yes, this is a tax discussion, but you cannot properly prepare a tax return unless some very good accounting has been done properly before you get to the tax return. And construction accounting normally varies away from either cash or accrual basis accounting. Even accrual can not give you a very good monitor of how good your company is doing because of the preferred methods are either completed contract, and that's usually when people have short-term contracts, 1 to 3 months. My demolition contractor is the perfect example of that. They do job cost things, but they do not have a percentage of completion element to things. And most of my clients are larger subcontractors, labor intensive, but some general contractors, and they all use the percentage of completion method where you compare how much your your actual cost is on a job or project versus how much the total estimated cost is on that job, and that's how much of the revenue you recognize. So revenue is not based on how much you build, but it's based on how much you've completed on a cost-to-cost basis. And it's a very unique type of specialty, and I'm going to guess it's one CPA out of 15 to 20 does that, maybe even a higher number that don't do it at all, because you really have to do it full time to be effective in it.
Do you find when you're working with new clients that come into your practice that you have to spend a lot of time educating them or helping them learn about these different methods of accounting that they should be using?
They still come to me and go, hey, I got to slow down my invoicing and increase my, getting all the accounts payable in that I need to from subcontractors. And then I have to correct them every time and go, that's not how we work in this environment, because the percentage of completion is the most accurate. It does not mislead owners of businesses nor the people who use their financials if it's done properly, because it actually is very accurate in recording the revenue that should be recorded and not just what was billed or what was not billed if they didn't get to it.
So if someone owns a construction, general contracting business, or maybe even a subcontractor, and they're currently using an accounting firm or a tax preparer that they're their only construction client, or maybe they have one other construction client there, does that sound like a situation that they should stick around in?
No, I think that's the first sign of you should get to a professional who does it full time, because I took a lot of time to get myself well versed in this, and it's something you should do regularly, not just occasionally, and not keep up with all the different rules. There's bonding company rules and insurance company rules, and banks either love construction or don't love construction, and you have to know the right banks to use when you have construction clients like this.
Okay, thanks, Don. Stephanie, you said you have a lot of clients in professional services and real estate, restaurants. What are some of the issues that come up in your tax prep and business advisory work with those industries?
I think it's important to understand your clients, first of all, what industry they are in and what issues that are specific to their industry. As Don mentioned, the accounting can't be undervalued. If you don't have a solid accounting to begin with, the tax preparation is faulty from the beginning. You have to have that solid foundation, and that's true in all industries, including things like professional services, real estate, and restaurants. For professional services, some of the things that we look at, and with professional services, I'm talking about businesses such as professionals like architects and attorneys, even CPA firms, doctors, medical practices, things like that. A lot of times those who are in professional service will establish a corporation, usually often a subchapter S corporation, to operate their business. This gives them certain advantages over running their business as a sole proprietor. They can do things with their health insurance. They have to look at things like their 401k planning and retirement. 401k planning and retirement is often an area that I think is overlooked, but that can have big benefits for a professional. They can help build their own retirement very quickly if they do like a cash balance 401k plan. And they also get the big benefit of the tax deductions when they are in a high income tax bracket. So there are some unique things that really help professionals in that area. Real estate is an interesting one, and Don has a lot of experience on the construction component of it. For example, is engaged in real estate rentals. We have to look at things like passive versus non-passive activity. Rentals as a default are considered a passive activity, which in the tax world, that's a very important designation. If you have passive activity income, that is taxed as regular ordinary income to you. But if you have passive activity losses, you can only use those losses to offset other passive income. So if you don't have any other passive income, those losses actually get suspended for future use. You don't lose them, but you don't necessarily get to benefit from them in the current period.
No, from my experience working at the IRS and then in public accounting afterwards, the IRS loves to audit passive activity losses when they see those on a tax return.
Absolutely. And one thing to consider with the real estate are there are ways to get around those passive activity rules, but you have to be careful. As you stated, it is something that is heavily audited by the IRS. And so you want to make sure that you have everything aligned properly and you have good documentation and record keeping.
Oh, sorry, Steph. I think people see a lot of things on social media these days. There's a lot of business and pseudo tax advice going around out there, and people might see something on one of these posts, a YouTube video or an Instagram reel or TikTok before that was shut down, and they think just because they saw it on there that means they can take this deduction for their business or whatever. Do you spend any time re-educating clients about what is actually possible?
Absolutely. And it's funny you mentioned that. I actually had a client this morning that asked me a similar question. And he is a professional as well. And he has a corporation and he's questioning things about whether he should have a corporation or run everything through as a sole proprietorship. And entity classifications are an important part of tax planning. He was talking to, some of the people that are in his industry, has some information and he has a little bit of knowledge, but it really takes a deeper analysis to determine what the best track is for a specific set of circumstances. There's a lot of rules and then there's a lot of exceptions to those rules in the IRS tax code, and you have to take a deep dive into some things to see how it really impacts a specific client with their specific facts. Very often, the client's friend or colleague or associate that's telling them this thing, or YouTube or TikTok or whatever, they don't have the same fact pattern, and there's little nuances in their fact pattern that could have a big difference on what really works for that client.
And the client's choice of entity structure, there's other considerations alongside just tax filings. It's liability protections, limited liability. You can't really get into all the details and the facts and circumstances in one social media post.
Certainly, and I think it's important to work with a group of professionals on that. We are CPAs, we're not necessarily practicing attorneys. However, it is important to consult with attorneys on certain things that involve legal decisions, because those have a big impact on a client, and really the client needs a whole team of professionals to help them with their business practice.
Agreed. Let's talk a little bit about tax deductions and tax credits. I think once people learn about tax credits, they really love those because they're a dollar for dollar reduction in tax and not just a reduction in their taxable income. Don, what are some of the tax deductions or tax credits that your construction company clients are commonly using or should be using?
The two that come to mind the quickest, one is the R&D credit, which actually the contractor would be the one getting it. The contractors I have, I think mechanical contractors may use the R&D credit the most because they do a lot of designing on the fly and have design and build contracts because of the things they run into after the architects have done something, or even if they're working on something that was existing. So, and we are involving our specialty part of the firm in helping those clients with the R&D credit. The energy credit probably normally goes to the owner of the property that construction's involved in, but the contractor needs to be well aware of what are good energy things to put in. So we actually do get involved sometimes that, hey, yeah, that's going to create a 30% tax credit when you put that in, or whatever, the customer wants as well. So those are the two that I find the most relevant.
Is the energy credit around installing energy efficient mechanicals and things like that?
Yeah, 100%. I mean, it could be solar. And, a lot of the commercial buildings nowadays have these built-in solar things that don't look like solar you see on residential roofs, but they're actually in between those windows that you see on the big tall buildings. That's all solar stuff, even though it doesn't necessarily look like solar stuff. And they can run some of those buildings almost, electricity free with the solar power that they're getting if they're located in the right places and the electricity is just a backup.
so they can reduce their energy consumption and their energy bills and also qualify for a tax credit. That sounds pretty good.
It does.
Steph, what kind of things are you seeing with your clients when it comes to sort of frequently used tax credits or tax deductions? I'm thinking there must be some of your professional gambler clients that think anything's deductible because it's for their gambling business. Maybe I'm wrong. Well, what are you seeing in your practice?
No, you're right on that. I've seen professional gamblers that will want to, and you have to be careful because some things are legitimate business expenses, but you really need to be careful if they're really personal expenses as well. For example, I have one that wanted to deduct things like personal massages, counseling services, mental health counseling services to help him, get in the game and focus and, different things like that. So some of that could have a legitimate business purpose, but you really have to be careful on that to make sure that you're not crossing the line on what's a personal expense versus a business expense.
I think that's the sort of stuff too that you hear, oh, well, my friend or my neighbor or my brother-in-law did this. Anyone can say, I got audited by the IRS or the state taxing authority, and they gave me a refund, and you have no way to disprove them. They could be telling you a story.
Well, and with gamblers too, gambling is a different type of business, and it can be treated as a business for certain professionals. For example, like a professional poker player, they've actually, determined it really is a skill set rather than a game of chance. And a lot of professional pokers, they will operate as if, the same as a business enterprise. And one of the interesting things with professional gamblers, though, some years they will have a really, really, really good year. In other years, they'll lose a lot of money. That's the nature of the game. But in professional gambling, their losses in a loss year are limited to their income, meaning they can't have a net loss to offset other income. And if they lose in one year, a couple $100,000, that loss is just gone. It doesn't carry forward. You can't carry it back. It's just gone. Even if the next year they made, $2 million, they really have to kind of manage that a little bit and know that that's a risk of their trade, for tax purposes. And so when it comes to deductions in the professional gambling arena, you need to factor that in too. Is it really worth trying to take a risk, a risky deduction that may or may not be challenged that really doesn't give you a tax benefit anyways?
This is all really interesting because both of your practices are so unique, but it seems like a common thing that I'm hearing here is that it's so important to work with a trusted tax professional.
Thank you for tuning into this episode of the Balancing Act podcast with Singer Lewack. We hope you found our discussion on business tax prep insightful. To recap, we covered unique accounting methods like the percentage of completion in the construction industry, as well as tax preparation challenges. Remember, effective tax preparation starts with meticulous accounting. If you haven't listened to last month's episode, Maximizing Your Deductions, a guide for individuals, be sure to check it out. For more information on how we can assist you this tax season, visit our tax advisory page. Stay tuned for our next installment in the Navigating Tax Season series airing next month. Until then, keep balancing your financial success.